The Federal Reserve just made its July 2025 interest rate decision, and it could impact everything from your mortgage to your credit cards, and even your job. If you're wondering what the Fed actually did, why it matters, and what you should do now, you're in the right place. This is American Ledger, where we break down the U.S. economy in plain English. Let's get into it. On July 2025, the Federal Reserve announced it would interest rates by 556, bringing the federal funds rate to 60 death. This is the rate change since March 2022, when the Fed began tightening to fight inflation. The decision was widely expected, but markets are still on edge. Because this rate doesn't just affect Wall Street, it affects your wallet too. Let's talk about the why. Inflation in the U.S. is currently at 39,566 on the peaking in 56, but still above the Fed's 2% target. Prices for gas and groceries have cooled, but core inflation, like rent, insurance, and services, remains sticky. Meanwhile, the job market is hot. Unemployment is low, wages are rising, and consumer spending hasn't slowed much. The Fed is walking a tightrope, trying to cool the economy without crashing it. That's why they made this move. Now, let's break it down. How does this affect you? First, loans and debt. If you have credit card debt, prepare to pay more. Most credit cards are tied to the prime rate, which moves with the Fed. That means more interest piling up every month. If you're buying a car or home, loans just got more expensive. A 30-year mortgage could now be near 7% depending on your credit. Second, savings accounts. This is the good news. Online banks are offering 5% or more on high-yield savings. If your money's sitting in a traditional bank earning nothing, it's time to move it. Third, investments. Rate hikes usually hit the stock market, especially tech and growth stocks. But bonds are now paying better, and investors are rotating into safer sectors like healthcare and utilities. Lastly, jobs and small businesses. Higher borrowing costs mean companies slow down hiring. Small businesses relying on credit may pull back or pause expansion. That can affect the job market too. So what should you do right now? Number 1, pay off high-interest debt. Every Fed hike makes it more expensive. Number 2, lock in fixed-rate loans if you're borrowing. Number 3, move your savings into high-yield accounts or short-term government bonds. Number 4, adjust your investments. Diversify, stay defensive, and hold some cash in case opportunities come. Number 5, stay informed. The zero-interest era is over. Financial knowledge is no longer optional. It's essential. This Fed move isn't just another headline, it's a warning sign. What do you think the Fed should have done? Raised, paused, or cut rates? Let's talk in the comments.
Thanks for watching American Ledger. If you found this video helpful, give it a like and share it with someone who needs to stay informed. We break down complex U.S. economic stories so you don't have to. Subscribe for straight facts, smart analysis, and zero fluff. See you in the next one.